It's Tuesday, June 9th. Welcome to MarketFoolery. I'm Chris Hill. With me today, Mr. Jason Moser. Good to see you, my friend.
Hey, how are you?
I'm doing all right. We've got some retail. We've got some apparel. We're going to dip into the Fool mailbag. We've got some cloud software earnings to get to. We're going to start with Macy's because Macy's is scheduled to come out with their first quarter report in a few weeks, but preliminary results out today indicating Macy's loss is going to be a little smaller than Wall Street was expecting. They've also raised $4.5 billion in debt to help shore up the balance sheet. So what do you think, Jason? It's a little better for Macy's, yes?
Yeah, I mean, it is better in the sense that they have bought themselves some more time. We always talk about it's tough to use debt to get yourself out of debt. And some point down the line, Macy's they're gonna have to figure out how to reconcile that. But for now, I mean, this does buy them, time, which is really what they need most of. In that very close second is shoppers, right? But I mean, you go back a year, okay? Go back a year from today. We were talking about Macy's and the challenges the business was facing well before the pandemic ever hit. I mean, at that point from 2015 on, top line revenue had fallen 11%. Net income had fallen 33%. Earnings per share were down 22%. And then, I mean, they had burned through a considerable amount of cash along the way. Around 70% of their cash balance they had burned through since 2015 as well. So, I mean, this was a business facing a lot of challenges a year ago. Fast forward to today, I mean, clearly those challenges have only grown. It's hard to imagine. I mean, we've talked about this with JCPenney for so long. Does the world really need JCPenney? I mean, we can ask the same thing. Does the world really need Macy's? I mean, I don't know if it really needs it. I do feel like maybe there's a bit more of a spot for a Macy's in our retail landscape here, and I am hopeful that management is able to weather the storm. But I mean, it is going to be a monumental task going forward, and we still don't know how this coming fall is really going to shake out. I mean, there's enough uncertainty, I think, in regard to what the fall season is going to look like here as far as the pandemic goes. If we can get through the fall season with relatively mild conditions, this holiday season is going to be a pivotal time for Macy's, one where they can really capitalize. But for now, I mean, they bought themselves some very valuable time.
They did. You raise a good point in terms of the timing, because we know that for a lot of retailers, the most important time of the year is the holiday season in December. Second most important is back to school shopping. We're going to obviously see the extent to which schools open up, but that is an opportunity for Macy's, and hopefully they can take advantage of it. But you just reminded me of the conversation we had last week on Motley Fool Money. We were talking about Dick's Sporting Goods and sort of this idea of, someone's got to survive, right? I mean, all sporting goods stores can't go the way of Sports Authority, right? There's got to be one left standing. At least that's my thinking. And I'm wondering the same sort of thing about Macy's. Like it has more brand equity than JCPenney. They historically have done a better job of managing their footprint, managing their inventory, which is tough to do. So I'm not buying shares of Macy's, but it wouldn't surprise me if they were not only around in 5 to 10 years, but in better shape from a financial standpoint.
Yeah, I mean, I think that's a fair observation. I mean, I do feel like Macy's holds a little bit more status in the retail space than something like a JCPenney. I mean, they do have. I mean, it's a blessing and a curse to have that sort of anchor position in a mall environment. I mean, I don't think malls are going away. I mean, look at something like Simon Property Group and their exposure to the mall segment of retail. I mean, that is, you've got companies that are very good at what they do in managing those real estate portfolios and putting ideal tenants in those malls. I think, Macy's falls into the category of, one of those ideal tenants that they would want to see. I think that Macy's certainly can exist. I don't doubt that one bit. Maybe it's in a smaller form. Maybe it's something where private equity comes and takes this thing out of the public markets. I mean, the public markets, while we love them, obviously it's a great vehicle to growing wealth over the long haul for investors. I mean, it's a very heavily scrutinized part of the world, right? I mean, that's sort of the downside for companies that go public is now you have to be fully transparent and you have to bring all of the bad that comes along with the good. And there can be a snowball effect. I mean, when a company like Macy's starts feeling a little pressure and they start, finding themselves in a precarious position, that can snowball. Investors can be very unforgiving when it comes to that stuff. But yeah, I do see a world where Macy's exists, albeit in a probably smaller form. Whoever is going to be leading the company over the coming years, it's just going to be a monumental task. They will definitely earn their money.
Shares of Coupa Software up 4% this morning. First quarter profits for the cloud software company came in much higher than expected. Coupa also gave some pretty solid guidance for the rest of the fiscal year.
Yeah, that was really interesting, I thought. In a market where everybody's suspending guidance, Coupa, they're out there offering guidance, and they actually raised guidance a smidge when you look at it. This is a really neat business. I mean, the biggest risk to a business like this today, from an investment perspective, really is valuation. It's still a young business, a new business, very modest cash flow numbers. It's still unprofitable. It trades at around 35 times sales, which we've seen a lot of these software companies do. But I mean, the flip side there, it is growing like a weed. Management's targeting 30% annual revenue growth. I mean, this is a company that is still growing very quickly, and they're pursuing a very big market. To give you an idea of what they do, Coupa, it's in business sales management. Ultimately, they draw an analogy with Salesforce in that Coupa is to business sales management as Salesforce is to customer relationship management. I think that's an apt comparison. And if you look at what Salesforce is today, the success that the business has had to this point, I mean, that's a flattering analogy. I mean, if you're Coupa, you like hearing that because it gives you some optimism that you're making the right decisions there. And so this business sales management focuses on helping businesses in procurement, invoicing, expense management. And when I mentioned the biggest risk to the business on the side of the valuation, 35 times sales. And just to give you an idea of how different the market can view different companies, okay, I'm not comparing Coupa to Macy's. Obviously, it's apples and oranges. But Coupa at 35 times sales, Macy's is trading at about 0.1 times sales. So that gives you an idea of the expectations the market has for these different types of businesses. And so we obviously like these software businesses, and they're pursuing a big market, but you have to be careful with the valuations when it comes to them. But they have tremendous network effects in play here. And, one of the metrics that we pay attention to with this company quarter in and quarter out is what they call cumulative spend under management. That's essentially just all of the money that's being spent throughout their customer base. And that chalked in at $1.8 trillion this quarter versus $1.2 trillion a year ago. Now, they're not monetizing that, right? They're not getting like a sliver of that $1.8 trillion, but it's an indicator of the health of the business and the growth of the business. And that, along with its attractive subscription revenue model, I understand why the market is giving this thing the valuation it's giving, because there are some great expectations, but these guys certainly seem to be up to the task.
I guarantee you that at least one of the dozens of listeners who is a value investor heard you say Macy's is trading at 0.1 times sales and thought to himself or herself, really?
Well,
I might need to take a look at this.
And we've talked about that before, right? I mean, that's the question with Macy's. Is it a value trap or is it a value play? And I mean, in my heart of hearts, I want to see a world where Macy's exists, and I gotta say value play there, but it's impossible to really predict the timing there, which makes it such a tough one to really fully buy into. But clearly the market looks at these businesses very differently.
Tough day for Tailored Brands. Bloomberg reporting that the parent company of Men's Warehouse and Joseph A. Bank is considering filing for bankruptcy, and shares of Tailored Brands down 15% today. We've been saying for a while, we don't want to be in this new environment in the business of selling men's suits. And Tailored Brands is 100% in that business. And not surprisingly, this is really tough for them.
It is, and yeah, I mean, it really strikes me that I mean, we had a listener, I believe his name was Benjamin, who chimed in a little while back with this. I'm just going to go ahead and reiterate: this may be the time, Chris, for us to bring the wardrobe mullet idea to tailored brands, because clearly they need to consider some type of a pivot, some sort of corner that they need to turn to take this business in a little bit of a different direction. Maybe the wardrobe mullet is it, because of all of these Zoom calls in the way that we're meeting remotely now. I mean, we're talking about those nice shirts and collars and ties on top, but really, business up on top, party down below, whether it's shorts or jeans or flip flops or what have you. Maybe there's something there. I don't know. But in all honesty, it does feel like with tailored brands, I don't know that there are any really good options. It's more like only the least bad one. It just seems like they are pursuing a market that's shrinking. We talk about looking for large and growing market opportunities, and there's a reason why, because I think when you look at what Tailored Brands is doing, even consolidated as the Men's Warehouse and Joseph A. Bank, I mean, they're ultimately pursuing what seems to be a shrinking market, not a growing market, and that makes it very difficult. As far as investing goes, I mean, clearly, I would never pursue an investment based on whether or not they will pursue bankruptcy. I think we talk about investing in long-term trends or short-term catalysts. I think the long-term trend for this business, regardless, is bad. So if you're looking for that short-term catalyst in whether they get some financing or a lifeline or whatever, that's fine. But the trouble with trying to invest in a short-term catalyst, you really have to time it right. And that's really difficult to do. I mean, that's imperative that you time it right, and that timing is just really difficult to do. So, again, maybe there's a world where this company needs to exist. Maybe it's in a much smaller form. But yeah, I don't envy management at this point, because I don't know that there are any easy answers.
Our email address is marketfoolery@fool.com. Got a question from Harrisville, Utah. Thanks for the insight on Teladoc. I believe the company is solving a serious problem in the healthcare system, and I'm cheering them on. I recently visited my doctor, and he recommended a follow-up video. However, due to the relaxed restrictions during the pandemic, we set that up over Google Duo. They also indicated that the hospital was developing an in-house app. So what long-term durable moats does Teladoc have in place against competitors? Is HIPAA a meaningful obstacle to entry? Thank you for your voices of calm humor in troubling times. Great question. And, we talk about Teladoc. I mean, that's one of your favorite stocks. This is a land grab. I mean, Teladoc, Google Duo, there are so many. I mean, I had a telehealth visit a couple of months ago, and my provider was like, nope, you got to download, I think it was called Helo, Healow. So this is a land grab.
Yeah, it is. And I'm glad that that he brought up the HIPAA dynamic there, the Health Insurance Portability and Accountability Act. I think that was something that was developed back in 1996 or so. But ultimately, HIPAA is something that it's meant to help shore up any weaknesses in our healthcare landscape, whether it be privacy or whether it is, keeping healthcare providers continually educated, continually up to speed with the regulatory environment. And so with HIPAA, as the pandemic has developed, HIPAA, they haven't really suspended HIPAA. I think it's more that they are just relaxing the regulations. They're not really pursuing any punishment of violations of HIPAA regulations. And that's a good thing, right? I mean, we've hit a point where really we need to see the merits of telemedicine. And that's true. That's proving to be a very helpful solution in this time where we're getting out of the house and going to sit in a doctor's office isn't necessarily as attractive a proposition as it once was. So, I mean, with HIPAA, that is a big regulatory hurdle that healthcare providers need to clear, right? I mean, there's security involved. There are policies and procedures in place. You have to understand all of the HIPAA dynamics as it applies to your business. You have to document everything. You have to create an ongoing training program.
Right. That's why anytime you go into the doctor, HIPAA is the law that basically protects your health information. So that, so the whole idea of you're going to have a private setting to meet with your doctor so that nobody else has access to what you're being treated for, what conditions you may, all that sort of thing. But yeah, as you said, I think it was the Department of Health and Human Services sort of relaxing those federal regulations to make it easier for hospitals and different medical practices to engage in telehealth.
Exactly. Yeah, and I think that was the right thing to do. I think it really helped, shore up some extra supply for a demand problem that was coming down the pike. I mean, going forward, longer term, I don't think that that's going to be something that becomes the norm, right? I mean, I think that at some point or another they get back to fully enforcing HIPAA guidelines, because that's what it's there for, and it's there for good reason. And so I think, honestly, I mean, this is something that really actually demonstrates all of the work that Teladoc Health and other telemedicine providers have done to this point in building out their networks and building out their companies so that they're HIPAA compliant, right? I mean, there's a lot of work that goes into that, and as HIPAA does become something that's more enforced down the road, I mean, I think that just will go back to the regulatory challenges. There are some barriers to entry in this line of work in the form of regulatory barriers, and I think that's something that we'll continue to see. And so I think with Teladoc, as far as a durable moat, I mean, moat's a very strong word, and I know it's something that gets thrown around a lot thanks to Buffett and Munger. Now, I mean, I think moat. I don't know that necessarily Teladoc has a strong and durable moat. I think they're building it. I think that they're building it by virtue of this comprehensive offering that they have. I mean, this is not just a visit the doctor on your phone anymore. To the point about the hospital building out its own telemedicine service, that was actually the logic behind Teladoc's acquisition of InTouch Health here recently. They bought InTouch Health, and InTouch Health is essentially a provider of those services to enterprises. And InTouch Health is helping hospitals build out their own telemedicine offerings. So that very well could be something that Teladoc is a part of in that particular situation. But again, I mean, I think it goes back to the strength in the network and the comprehensive offering and what Teladoc Health has been building out. Another quick example, and I found this very interesting at their recent investor day. When you look at primary care, right? When we talk about primary care and how important that is to keeping a long and healthy lifestyle, and primary care is something that really many adults lack a primary care doctor. In the data, actually, back in 2018 showed that from in ages 18 to 29 years old, 45% of those adults lacked primary care. They didn't have a primary care team. 30 to 49 years old, 28% didn't have one. And I mean, that's for a lot of different reasons, but access is certainly one of them, and one of the big ones. And so Teladoc is working on reimagining the primary care relationship in order to bring that to more individuals that could benefit from it. So I just think it all kind of goes to that comprehensive offering that Teladoc Health is building out. So is it a moat? I don't know that I would call it a moat, but I would say it puts them in a very strong competitive position compared to their peers. And I think that as the HIPAA stuff is enforced down the road, that'll become a bit more apparent.
Right, and if you're in the video conferencing business, HIPAA is one of those things that you have to look at and say, okay, do we want to invest time and resources to clearing the regulatory hurdles to make our business HIPAA compliant?
Sure.
Earlier this year, we had, the whole idea of Zoom bombs happening. It's like, yeah, and you and I have joked like, hey, if someone wants to Zoom bomb us while we're just talking, that's fine.
Sure.
Not when I'm meeting with my doctor. No, no,
not at all. And I mean, that's a good point. I mean, Teladoc, they've built their service, their platform from the ground up. I mean, they're not relying on Google Meet or Zoom video chat. I mean, they own that relationship, and I think that's something that's worth keeping in mind as well. I mean, they have invested a lot of money in that business through the years to build out what they have, and I think they're continuing to head in the right direction.
By the way, that question came from Sean in Harrisville, Utah. I had misplaced his name earlier. So, Sean, thank you for that. Real quick, before we go, one last, you can send us the email, marketfoolery@fool.com. You can also hit us up on Twitter, @MarketFoolery is the show's handle. Question from Neil in Rockville. Where does Google's Meet come into play in the battle between Zoom and Microsoft Teams? Thanks. I'll hang up and take my answer off air. Love that. we pay a lot of lip service, and rightfully so. I don't mean that in a pejorative way. When we talk about Zoom, we also talk about Microsoft and Teams, and we talk about Cisco systems with WebEx. We don't really talk about Google's Meet. I actually had a Google Meet video call last night with some friends from high school for about 2 hours, and it was my first time using it. It was great, easy, simple, all that sort of thing. Basically, what you want in those systems. If Google is pushing this in the same way that Microsoft is pushing the video offering as part of Teams, I'm unaware of that.
I don't think they are. I mean, I think that I think that while Google Meet is certainly a noteworthy option, I think it has the advantage of being part of the Google universe, and Google has a very good reputation for building services and platforms that garner a lot of users. I mean, I think they have 9 now with 1 billion users or more each. Google Meet has its merits. It used to be known as Google Hangouts Meet, but ultimately it's their enterprise group video conferencing solution, and it's been made free to everyone during this time, just as Zoom has been in everyone else. So, I mean, I think with advantage, being that it's in that Google network, it's a Google service. People who are familiar with Google services, it's going to be something that's relatively consistent there. I think security is probably the big leg up there that Google has right now on Zoom. I don't know actually that really matters, and one of the reasons why is because I think it becomes more apparent when you start to look at all of these different Google offerings. It's confusing. I mean, you have Google Meet, Google Hangouts, Google Duo, Google whatever, and so they do have this landscape that becomes a bit cluttered at times, and it's a bit confusing as to what is what and why I would use one over the other. And I think, the flip side, that's maybe an advantage that Zoom has really been honing in on is that they do one thing and they know what it is and it works, right? I mean, that's what they do. It's not confusing. And I think maybe with Google and Google Meet, there's still maybe some confusion as to what it is, who it's for, and that could be a problem. And then when you couple that with the fact that Microsoft is doing such a good job in really getting the word out there for Teams, I wouldn't say that Google Meet is something to ignore, but I also wouldn't say that I'd be far more worried about Microsoft Teams as opposed to Google Meet if I'm a Zoom shareholder.
Well, and when you consider how much cash Alphabet has on its balance sheet, it's really just a matter of waiting to see the extent to which they are willing to deploy it to get this to be the default video conferencing that people use, and it's basically going to the CFO, Ruth Porat, and making the business case. So I agree with you. I think, again, just had my first experience last night. It was great. It was easy. I have no trepidation about using it, but I would wait to see a clear signal from Google and Alphabet that they are willing to invest in this to make it the go-to, that there is a business outcome for them where Ruth Porat signs off and says, okay, yeah, go spend the money, do what you need to do, because I see the pot of gold at the end of the rainbow. I don't think they've done that yet.
I don't either, and I don't know that they will. I think if you list off all of the priorities for Google and Alphabet in really where their best opportunities are, I don't know that they view Google Meet as necessarily that opportunity. Is that juice worth the squeeze, so to speak? I think Google management is probably smart enough to recognize that it's not. It'll be something they have. It'll be something that some people use. But I don't know. I think the signs of Google Meet's success would become very apparent in a fall off in the performance of something like a Zoom.
Jason Moser, thanks for being here.
Thank you.
As always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against, so don't buy or sell stocks based solely on what you hear. That's going to do it for this edition of Market Foolery. The show is mixed by Dan Boyd. I'm Chris Hill. Thanks for listening. We'll see you tomorrow.